Okay, so I went to University of Pennsylvania for undergrad in Philadelphia, and I had absolutely no idea what I wanted to major in. I had no idea what I wanted to do when I grew up. I kind of still don't necessarily know what I want to do when I grow up, but this is working out so far, so I kind of will stick with this. And I couldn't decide on a major, because a major meant commitment. You had to commit to political science or history or whatever it is. So I found the perfect major to choose, which is called, they just had started it. I was the first person that graduated, called Philosophy, Political Science, and Economics. It's basically like the smorgasbord of majors that I could take a little bit of philosophy, a little bit of political science, a little bit of economics, and then decide what I wanted to do. Still couldn't decide what I wanted to do, so I was talking to a friend, and a friend said to me something that I think is so important as you think about the next job for you, which is optionality. There are certain roles that you can take that will open up a lot of different options for yourself. You said you're thinking about a position now, you're thinking about a position now. And there are other roles that you're going to be exposed to a much more myopic, more narrow set of pieces of information. So for example, if you decide that you want to be a trader, you will develop a great expertise in trading, and you'll even know trading kind of inside and out. But if one were to instead do investment banking, both finance jobs, you become an analyst. You learn analytical skills. You learn Excel spreadsheet skills. You learn all these skills that could be used for lots of other positions. So the choice that I took, I sent my resume, because you couldn't email resumes back then, you just kind of mailed them. And I mailed my resume to 50 different consulting firms, because I thought, if you don't know anything, you consult. It's perfect. So I ended up getting a job in a consulting firm, and I chose that specifically because of optionality. Because you could be consulting on a project on pharma and then present yourself, oh, I know pharma. I could talk at a job in industry in pharma, or in high tech. Oh, I know high tech because I consulted to a job in high tech, or a sales project, or a technology project, whatever it is. So specifically what we did was post-merger and acquisition integration consulting. Okay, that's a lot of words, but what that means is after companies are acquired, what do? You spend hundreds of millions of dollars in a company, what do you do after they're acquired? So that was great because of optionality. And it just kind of exposed me to all these different things. My biggest client at the time was a company called DoubleClick. Anyone here of DoubleClick? Okay. DoubleClick was everything back in the day in New York. DoubleClick was acquired by Google for $1.7 billion. It was the Silicon Alley company. And my biggest client was DoubleClick, and the CEO came to me and he said, we're paying $300 an hour for your advice. Of course, I'm getting $12.13 of that. And they said, what are you making? Okay, see what you're making. If we double what you're making, we'll still be saving $230 an hour. So I ended up moving to DoubleClick because it was an opportunity for them to save some money and to get an in-house expert. And for me, it was an opportunity to get an experience actually working within a company as opposed to just working in consulting. Okay, so I worked for, and part of career is, besides optionality, I'm going to talk about 4 different themes. One theme is optionality, so choosing paths that have lots of options. The second theme is just damn luck. So, that's it. It's luck. There's a lot of people that end up in a company. I ended up at DoubleClick. It was a leader in the whole digital media space. Our stock literally went from $10 to $200, back down to $30, up to $80, down to $5 during the times of the rise and fall of NASDAQ. And that was just luck, and that just sometimes just happens. And because of that, there weren't many digital companies. After only 2 years there, I became an expert in digital, which of course I wasn't, but there were no experts in digital at the time. Anyway, then I went to Wharton for business school. After business school, I saw these different companies coming to campus. And there were the Goldman Sachs's and the banks and the big consulting firms and BCG and McKinsey and all these places coming to campus. And I wanted absolutely nothing to do with any of those firms that were coming to campus, because I just thought it didn't excite me. I really wanted to work for a company and roll up my sleeves and do something real as opposed to advise people on something. So I was very proactive. And that's the second theme of proactivity. I want to tell you a story of how I kind of landed a couple of jobs after that. I was able to figure out what the email addresses of, first I put together a list of like 30 different companies. Okay, like I thought, oh, JetBlue, that's a cool company. It's based, I want to be in New York. Let's talk to them. 100 Flowers, let's talk to them. Just a bunch of different companies that I thought were interesting. Put 30 companies together. And then I figured out what their email addresses of how the email worked, whether it's David.Siegel, David_Siegel, D Siegel, whatever for the email. Then I was able to find a list of like like 20 or 30 executives that worked there. It didn't matter if they were like the chief janitor, chief bottle washer, whatever it is. I then one night stayed up and I literally sent out 2,000 individual emails in one night, okay, to like 50 people or 50 to 100 people at these 20, 30, 40 different companies. And I get an email, I say, Frank, I'm really interested in working for JetBlue or whatever it is. And specifically, I was interested in a position as assistant to the CEO. Okay, what that means is putting board decks together, advising them on different things, not like getting them coffee per se. So I said, I'm interested in an assistant CEO position. Frank would then say, I'm the chief bottle washer. Why are you talking to me? But James over here is the guy that you need to talk to. So, and then send an email to James. I said, James, Frank recommended, like me and Frank are like the best of buds for, years and years and years. Frank recommended that we speak. And I ended up talking, I kid you not, to about 8 to 10 different CEOs of companies. David Stern, who was the commissioner of the NBA at the time, I spoke to him. A whole bunch of CEOs of companies. I just had like 20-minute conversations that I should be the assistant to the CEO. One of them was Dwayne Reed, the pharmacy chain, because I'm like, what's the opposite of consulting? It's like retail. Like roll up your sleeves. So I actually ended up working there for 3 years. So I really tried to not take the path that was handed to me, but instead say, where do I want to go? And how do I differentiate myself and be extremely proactive in trying to get there? Anyway, I'm at Dwayne Reed, and a buddy of mine who was in business school with me sends me an email. And the email says, you got to check this out. I said, what is it? He sends me an email, and there's a job description. And the job description is 1-800-Flowers' CEO, a guy named Jim McCann, he's in the commercials, all the flower commercials, is looking for an assistant to the CEO. I'm like, that's crazy. 4 years ago, I talked to Jim, and I was calling him up, and I was trying to convince him, Jim, I want to be your assistant CEO. And he was like, no, I have an assistant. She gets me coffee. I don't need that. What are you talking about? I'm like, no, I'll help you with board decks and strategy and, whatever thing I'll help you with. So I get the email. So I send an email back to Jim, and I say, Jim, I don't know if you remember me, but 4 years ago, I had a 20-minute conversation with you back when I was in business school. If in any way that influenced your decision to look for an assistant CEO, wow, golly gee whiz, that's so cool. And I guess I didn't do the golly gee whiz part, but everything else was true. And he emails me back 5 words. I was looking for you. So he posted like this job on Warden. It was like, I only posted on Warden. He didn't post it anywhere else. Because he's like, I remember the conversation. I thought it was really intriguing. And I thought maybe I'd be able to find you if I posted a thing. You'd be keeping up to it. I'm like, that's cool. So I worked at 1-800-Flowers for 5 years. And my first job there was Vice President of Strategic Initiatives, which basically means we think you're smart, but we have absolutely no idea what you could do here, but we just want to hire you anyway. So we're just going to hire you for this kind of made-up role, and then we'll figure it out kind of along the way. And then by the time I left, I was Senior Vice President of a bunch of stuff, but I ran M&A for the company and post-acquisition integrations and marketing across a number of disciplines and a few businesses, small businesses rolled up into me. It was a great 5-year kind of experience. But the only reason I got the job was because I was kind of proactive 4 years prior. So kind of theme number 1 is optionality. Theme number 2 is just damn luck. Theme number 3 is just proactivity. It's just so important. You know, when people say, I can't find the job I want, whatever it is, like, are you sending out 2,000 individual emails? No? Then do it. Like, come on. So that's proactivity. So, I'm crazy, but still, whatever, it's worth it. I mean, it's what you're going to be, think about, your job is going to be what you're doing for more of your awake hours than anything else. You want to love it. You want to love it. So you want to make sure it's for the companies that you love, at least that you find interesting. So at 1-800-Flowers, and then, you know, I ended up going to Everyday Health, which is so 1-800-Flowers is a $1 billion revenue digital media company that owns not only flower businesses, but cookie, chocolate, all these other wine, gifting businesses. Harry & David, which is a fruit company, that's also owned by 1-800-Flowers. Everyday Health, $250 million business. They were looking for a job that I had absolutely no interest in. It was like 2 levels kind of below where I was already at. But I thought the company was really interesting. It was, it's the second largest after WebMD, kind of health publisher. And I said, you know what? Some people were like, oh, I don't want to take this meeting. This job isn't interesting. But you can't act like that. Instead, I said, this company's really interesting. I want to take this meeting, and then maybe it could turn into a totally different job. So I took the meeting, and they pitched me on this particular job, and I'm like, no, I'm not interested. I'm not interested at all. Like, the entire meeting was me basically saying, I'm really not interested in this role at all. And then we ended up having a follow-up meeting, and like 3 or 4 meetings, and then we crafted a position of me essentially running a division for the company that was a lot more fun and interesting. But again, that came out of the fact that I was kind of willing to take a meeting because the company was interesting, not just because the position happened to not be interesting. And again, what I would say there is, whenever you have opportunities in your career to have conversations with senior level people, don't focus on what the position is. Focus on who the company is, because the senior person could craft a position that could be really interesting. Actually, I just saw, anyone see the Steve Jobs movie that came out? Okay, so Steve Jobs movie. So a big guy in there is John Scully. Yeah. So like in this search of things, I spent like an hour with just meeting John Scully, like just randomly. It was great, because I didn't even have anything, but just take the meeting, you never know. So the theme there is take the meetings and try to turn into something that's interesting. The last two that I transitioned that I could maybe share with you, and then we'll take questions, is after 1-800-Flowers, I was there for 5 years, Everyday Health for 3 years. This is kind of so random. I was in Israel, okay, for a month with my family, and I read about this crazy tribe in Africa that is in Uganda, that actually all like 10,000 of these Ugandans converted to Judaism like 100 years ago. I'm like, wow, that's kind of weird. That's so fascinating. And they had never had like someone to lead Rosh Hashanah and Yom Kippur services at this Ugandan African tribe. Okay, this is actually how I ended up to be president of Seeking Alpha. And I had an opportunity. Someone said to me, David, we'll fly you out to Uganda to lead Rosh Hashanah services at this crazy place. So I came home and I said to my wife, I'm like, guess what? I'm going to Uganda. I'm going to lead services at this place. She's very smart. She said, you're going to go, but the only way you're allowed to go is if you find someone else to go with you. So I called up one buddy and I'm like, hey, let's go to Uganda. It's going to be an amazing experience. They're like, yeah, I'm going. And then like 2 days later, they said, I talked to my wife, can't go. Talked to my wife, can't go. Everyone like falling like flies. Then I remembered a friend of mine who was in Israel, who was a partner at Benchmark. Benchmark is a really big venture capital firm. Actually, they back Uber and a whole bunch of other like major successes they've had. And he's a partner at the firm. And I tried to convince him to go with me to Uganda. So just that meeting was only about Uganda. And he said to me, David, I can't go on that trip, but I have a better trip for you. And that's meet with the CEO of Seeking Alpha. And that was it. That's a better trip. I don't know. I ended up never going on this because I couldn't find anyone else to go with me, unfortunately. But through that meeting, I ended up meeting with the CEO, and we hit it off. And then he asked me to be president of Seeking Alpha, which is essentially about $20 million financial publisher that focuses on investment research around small and mid-sized capped stocks. It's extremely well regarded in the finance space. One of probably the best sites out there from a financial publisher space. So last story is I left to become CEO of Investopedia about 9-10 months ago. And the reason that happened is because IAC is Investopedia's parent company. You probably don't know IAC. IAC owns a couple of properties that you definitely know. One of them is called Tinder. Has anyone here heard of Tinder? I'm just kidding. I know you all know Tinder. No, well. So they own Tinder, Match.com, OkCupid, all these properties. They also own Investopedia, Dictionary.com, Ask.com, College Humor, Daily Burn, the Daily Beast. Daily Beast, they're probably one of the best digital owners of properties in the New York area. The office is actually not far from here at all, 12th and 18th Street. So they were saying, hey, we want to acquire Seeking Alpha because they acquired all these companies. So I presented to them about Seeking Alpha. We weren't interested in being acquired. But again, be opportunistic. Take the meeting because at some point, maybe you will be. So I gave this 3-hour presentation of like, here's this, here's that. Oh, and by the way, sorry, we're not interested in being acquired. It's like, whatever, talking for 3 hours and then asking someone on a date and then just saying, sorry, I'm not interested in actually going out. But anyway, they want you more, right? So we ended the conversation. I said, sorry, we're not interested in being acquired. 2 weeks later, I get a call from one of the executives that said, okay, I know that Seeking Alpha is not interested in being acquired, but are you interested in getting acquired? Meaning like you, David Siegel, because we just acquired Investopedia, we need a new CEO, and that's how we ended up here. So I think kind of from a theme standpoint, they're stories, right? But I think there's certain themes that come out of them. Being optionality, particularly early in one's career, where one doesn't know what path you're going to take. You could take 10 different paths. You just don't know what it is yet. Getting exposure and having the resume where you can justify taking all these different paths is so important. I can't emphasize it enough versus taking one micro thing. Luck, proactivity, being aggressive, relationships, networking, and that's the story of kind of career thoughts. So I was thinking about growth strategies because every one of my firms that I've been at have not been kind of flat 1 or 2% type growth environments. Besides Dwayne Reed, DoubleClick, massive growth. Same thing at 1-800-Flowers, at Everyday Health, Seeking Alpha, Investopedia. And I was thinking about kind of 3 themes that I would share around growth strategies. And then I'll go into specific examples of what our growth strategies were at 1-800-Flowers, at Everyday Health, at Seeking Alpha, and at Investopedia. And I think that could hopefully be helpful for you as you think about entrepreneurship and what the growth strategies are. Okay, theme number 1 in terms of growth. All growth is not created equal. All revenue is not created equal. It's very important to understand, and let me explain why. The path for a company is to either get acquired, to go public, etc. Companies have valuations. Public companies, private companies have valuations. Valuations are based on a multiple to whatever the revenue that number happens to be. That multiple can vary dramatically depending on what type of revenue it is. So there's types of revenue, this gets to my all growth is not created equal. There's types of revenue that $1 could be worth 3 times the amount of $1 in another area. And you understand why? Because of the multiple that can apply. It could be a 20-time multiple or 4-time multiple, depending on what type of revenue it is. So for example, if revenue is, in my world, revenue is oftentimes either subscription revenue, you subscribe to a site, like you subscribe to the New York Times or Wall Street Journal or bartender, or advertising revenue. When something is subscription revenue, it's a recurring subscription fee that you get year in, year out, unless someone leaves. And the likelihood of getting that revenue from year 1 to year 2 to year 3 is much higher than if you have to rebuild revenue every year. There's a lot less risk attached to that revenue. So growth through subscription revenue has a much higher multiple than growth through media revenue, because in advertising, you'll do an advertising buy for 2015. Guess what? I'm starting 2016 in Investopedia essentially at zero. I have to restart it every single year. So theme number one in terms of growth strategies is to have an understanding that all growth is not equal, and that certain revenue dollars are worth far more than other revenue dollars. For example, revenue that is in a retail store is valued at less than revenue that comes online. It's just a fact. Okay? So that's number one. Number two, growth. There are oftentimes two ways to grow from a financial standpoint. One can grow through one's P&L, or one could grow through one's balance sheet. Okay, let me explain what that means. P&L means you are taking on all these expenses, and that your profit you were making $2 million in profit. You now invest $3 million for growth in expenses. You're now $1 million negative in profit. Okay? That's what P&L means. Balance sheet is I have X amount of dollars in cash. Okay? It doesn't affect your profit. It affects your cash. And I can now invest dollars in cash. Typically, when you do an M&A transaction, we acquire a company that's investing through your balance sheet versus P&L. You can't underestimate the impact of a P&L versus a balance sheet impact in how companies choose their growth strategies. Meaning, if a company can acquire another business and spend $20 million to acquire that business, and it doesn't negatively impact their profit, there is oftentimes a much greater likelihood that they're going to be interested in doing so than if they have to spend $3 million and all that impacts their profit. So the dynamics of how one chooses to grow, acquisition versus investment, have a big impact. Third is kind of risk assessment. There are just many, many companies that are willing to take on significant risk and dollar investment in order to grow much faster. And obviously there are others that are not, and that has to do with the culture of a company. Some company cultures, frankly, are much more risk averse, and some company cultures are more risk taking. And understanding that level of risk is really important in thinking about a company's growth. So now we'll talk about 4 different companies that I've been at. I was at either a senior vice president, president, or CEO level. So I was kind of on the executive team for all these companies, and we would have dozens and hundreds of hours of discussions and debates and strategy sessions all about the growth strategy for each of these companies. So you're going to get inside the boardroom here. You ready? Okay. 1-800-Flowers. So 1-800-Flowers, $1 billion in revenue, 10 to 12 different brands, as I mentioned, a cookie brand, a chocolate brand, a wine brand. When we did due diligence, I'd have to drink lots of wine for all the wine companies we acquired. That was like horrible. Harry and David, fruit brands, fruit bouquet brands, all that, the fruit bouquets, all those types of businesses. So in 1-800-Flowers, the growth strategy was really 4 levels. Number 1 was around getting people to purchase, who were purchasers of one brand, to purchase from another brand. Okay? That was the biggest thing. We had a term for it called enterprise customer value, which is fancy terms that people inside companies usually like to put on things. ECV. But if you can get someone who bought flowers, and they bought chocolate, like a chocolate heart, for Valentine's Day with their flowers, and get them to now buy chocolate at Fannie Mae or Harry London, which is the chocolate companies that were owned, and become a purchaser of chocolate for Fannie Mae and Harry London, huge home run. Because what it means is you can acquire customers very efficiently. You don't have to spend $50, $100, $200 on TV advertising to acquire a customer. You could do it through your network. If you get people from Harry and David who buy lots of fruit to now start buying fruit bouquets on 1-800-Baskets, which is another brand within the company. Again, huge value. So cross-pollination of customers was number one prioritization for 1-800-Flowers' is growth. The second is around leveraging the database, which is very related. The company has 30 million names in the database who have ever purchased anything over the last 5 to 7 years across the portfolio of brands. Leveraging those names and mining those names. We had all these data scientists and experts in data that would say, this person, because of exactly what they purchased at that specific time, should get an email from this other brand at this time because there's going to be a 5 times greater likelihood of opening it up because they bought something for someone's birthday that had to do with chocolate or cookies or whatever. So mining data. The third, again, related to this whole cross-brand thing, is a rewards program. And to be able to get someone and say to them, hey, if you buy from any of these 12 different brands, then you get fresh rewards points, is what it's called, because all 1-800-Flowers food or flowers is fresh. So fresh rewards. And you could then use those points for other brands. And that was a good way to get people to try brands that they had potentially never tried before. And then the fourth, and this was M&A. Again, for the reason that I stated earlier, acquiring a company does not negatively influence profit. If you negatively influence profit, you will be negatively influencing EPS or earnings per share. If you negatively influence earnings per share, then you're going to be negatively impacting the potential valuation of a company, because many companies' valuations are based on a multiple to earnings per share, or a PE type ratio. So M&A never impacted that. M&A was positive towards that because you could acquire a company, acquire the revenue, acquire the profit. It would take cash down, but it was very, very positive. So that was some of the things that 1-800-Flowers focused on. In general, because when you do $1 billion in sales, you're not looking for like $500,000 here and like $300,000 there. You need like the big moves to really move the needle if you're going to try to grow 5, 10%, whatever a year. Okay. Next one, Everyday Health. Everyday Health was a great experience because I was at Everyday Health over the period where it went from private to going public. And the ability to, I'm going to talk more about this later, but the ability to go from a private to a public is a double-edged sword. Positives and major negatives, and we'll get to that. But in terms of the growth strategy for Everyday Health, so number one is the key in media, to be a successful media company, is to have a lot of eyeballs, to have a lot of people watching, whether it's your TV channel or your radio program or going to your website. The bigger you are, it has kind of an exponential impact on the ability to then get advertising dollars. Everyday Health was a company that has started up 10 years prior. And the question is, how is it going to get big fast? How does it drive all this additional inventory for ads on its site? Rather than trying to, and they built a number of sites, but it takes a while to actually grow sites, to make them faster, whether it's through SEO or other types of relationships. So what they said is, we have this amazing sales organization. We are going to go to all these other publishers who don't have as good and as interesting sales organizations, and we are going to guarantee them a certain amount of revenue, and we're going to sell all the ads on their sites for them. We're going to build a network of ads beyond just us. So they then got the Mayo Clinic, and they said to the Mayo Clinic, we're going to give you X amount of dollars, and we're going to sell all the ads in the Mayo Clinic. And if this is hypothetical, if you are making $10 million off the ads today, we're going to give you a guarantee of $15 million, and we're going to sell all the ads on your side. And we're going to go to What to Expect, the pregnancy site, what to expect when you're expecting. We're going to sell all the ads on your site. And they went to about 5 to 7 other digital publishers in order to get scale really quickly, to then be able to go to an advertiser and say, look at how much scale we have. We're bigger than WebMD. Or we're about the same size as WebMD. Give us the same size buy as WebMD. Before, they didn't have the ability to do that. But because they got so much scale by representing other firms through business development deals, that was a significant path, frankly, towards their growth. The next path that Everyday Health realized in terms of growth was data. So they also, just like 1-800-Flowers, had a massive database of users, and they were able to work and find out which people had, psoriasis, which people had rheumatoid arthritis, which people had, God forbid, cancer, or any other types of conditions that individuals were in. And they wouldn't sell individual information because that's illegal, but they would be able to target advertisement by big pharma companies towards those people with those conditions and charge, frankly, a very lot because it was so super duper ultra target. You can't target TV advertising in that kind of way. This TV show is only going to be for people with psoriasis. How do you do that? But you could target ads for people with only with psoriasis. Last two, Everyday Health. Seeking Alpha. So Seeking Alpha has a large media business. Media means that they monetize the site through advertising. But when they started to realize the valuation of businesses are higher for subscription than for media, like I talked earlier about, the growth strategy for Seeking Alpha was, how do I build a subscription product on top of our free product? New York Times has advertising and a subscription product. Wall Street Journal has advertising and a subscription product. All these are advertising and also subscription products. How do I build a subscription product on top of that? And then be able to get the valuation multiple of a subscription business instead of the lower valuation multiple of a media business. Okay, and they're in the process of building out quite an interesting subscription business, and it could be really, really exciting, frankly, for the company. Investopedia. So, as I mentioned, we're all about educating the world about finance and investing. We have 20 million users. Our growth strategy is a couple of things. I'll tell you three, and then we'll wrap up for questions. Number one is we have found a direct correlation. We're extremely data focused. We found a direct correlation between the type, creating content. Content leads to more traffic on our site. More traffic on our site leads to more revenue. It's very simple, right? The key is what type of content one creates. We have 2 PhD data scientists on our team. Data is a theme kind of throughout, that are literally former astrophysicists, that are literally, they're able to, that what they've done is they developed a couple of technologies that we only have that look at the differences between supply and demand of different types of content. Meaning, you want to write content about something that has a low supply and a high demand, and then we fill that need, right? So for example, if retiring in the Philippines has thousands of articles written about it, not that people are interested in looking at it, then don't write an article about it. But if retiring in Cambodia has tons of people looking for search on and looking at Google Trends, etc., on how to retire in Cambodia, and there's like 10 articles about it versus 10,000 articles on Philippines, go ahead and write like 30 articles about retiring in Cambodia. So we take this very, very scientific approach to our editorial and content strategy that enables us to know which types of articles will lead to significant traffic on our site, which is then monetized through advertising. So number one is when I started my job close to a year ago, we had 40,000 pieces of content in the 15 years that we created. I noticed this opportunity, and we created 20,000 pieces of content just this year. So in 1 year, we increased the total content by 50% for our business that it took like 15 years prior, because the ROI is there and it makes sense and we're doing it in a smart way. The second is video. I'm sure when I see my 14-year-old, he doesn't read anything on the web. All he does is watch videos. That's how he learns, that's how he reads, that's what he likes. So we are going from almost no video about a year and a half ago to we now have about 2,000 videos, and we're producing 200 videos on a monthly basis. And that's a big growth strategy for us. And then last is email newsletters. We have a couple million people signed up to, we have a ETF email newsletter, and a news you could use email newsletter, and a term of the day email newsletter. And we have, our goal is to increased the amount of traffic that we're getting through email from like 3% today to about 15%. Big growth, big focus, and that's it. So just to sum up, the 3 key themes or 4 key themes are leveraging data for growth is really important. It's not about like sitting in a room and saying like, I think I have a great idea. An idea means nothing. An idea backed up with data, an idea backed up with a hypothesis where you think what's going to happen, you test out what's going to happen, and then you actually see what's going to happen. It doesn't have to take a lot of time. In the world of digital, you can have an answer in like a day. When people don't take the tests and don't test things out, that's how they oftentimes fail. So data, all growth is not equal, benefits of M&A versus investing in the company, and then risk tolerance. So there's 2 good outcomes in exit strategies and 2 bad outcomes in exit strategies. The 2 good outcomes in exit strategies are either you go public or you get acquired. The 2 bad outcomes in exit strategies are you either shut down or nothing happens and you're just kind of around and you're there for 5 years and you're there for 10 years and you're there for 20 years and you're just kind of hanging out. And there's no actual transaction, there's no actual exit, which happens to a lot of companies. They're just there. That's not necessarily a bad thing, I should actually add, because there are numerous companies that don't have the capability to go public. They don't necessarily have an interest in being acquired, but they're throwing off enough cash that to just hang around and get $5 million a year in kind of dividends every year is a beautiful thing. So it's only not a beautiful thing if it's kind of a break-even business and it's not driving any meaningful dollars to the entrepreneur over time. But really, the 2 avenues are either go public or you get acquired. So I'm going to talk about kind of the 4 experiences that I've had, some having been acquired, some having gone public, etc., and the processes around that. And I've probably have met with over 200 to 300 different companies about acquiring the company. And I've met with a couple dozen companies about being acquired. So kind of did this game a lot. So it'll be tough to sum up in 15 minutes. But the first thing that I just want to say is entrepreneurs. Entrepreneurs sacrifice so much. They sacrifice their time, they sacrifice their family, they sacrifice immediate income. And the reason typically why an entrepreneur is not for the money. I've met hundreds of entrepreneurs. It's because they feel passionate about wanting to create a product and run a business that they care about. But in the back of every single entrepreneur's mind, it's not the primary reason. It's there is a path towards me being able to do X, whether X is retiring early, whether X is supporting their families, whatever X happens to be. I have never met an entrepreneur that, at least as a secondary or tertiary priority, there's not a dollar benefit to all the work that they've been putting into things. 100 Flowers. 100 Flowers started off with 1 store called Floral Plenty in the 1970s by a guy named Jim McCann. And it then acquired 30 stores. It then acquired the 100 Flowers name from someone else, actually. It didn't start with that name. It started with Floral Plenty. And now is a $1 billion $1.2, $1.3 billion publicly traded enterprise. The exit strategy for 100 Flowers was going public. It went public in 1999, 3 months prior to the NASDAQ peak. Had they waited probably 5 or 6 months, they may not have gone public for a few years. They likely would not have gone public for a few years. The reasons why, when I was at 100 Flowers, I ran M&A, and I talked to probably 200 to 300 companies about acquiring those companies. And I would say there's 3 reasons why companies were interested in being acquired, okay? And they fall into these 3 buckets. The first is they genuinely believe that the acquirer can help their baby, their company, to grow faster. So in 100 Flowers' case, we acquired a cookie business called Cheryl & Co., Cheryl's Cookies. You know it?
Oh, absolutely.
Great.
Yeah. Based
in Columbus, Ohio, delicious cookies. Mm-hmm. And the founder said, wow, we're doing X million dollars in sales right now, between 10 and $100 million, let's say. You guys are doing $500, $600 million in sales. You could unleash your customers to buy Cheryl & Co. Oh my God, you'll be able to build my brand, you'll be able to build our cookies, you'll be able to invest more in our factory. God, that's exciting. And for many entrepreneurs, the reason why they want to sell their company is because they love their baby and they know that the time for it to grow is under someone else's ownership where there's all these great things that can be leveraged as part of that growth. Okay? So that's the first reason. The second is, frankly, that entrepreneurs are the most risk. They have the most risk out there of any type of individual who's working in business, because 100% of their wealth is tied up in the future success of this one company, and that's scary as all hell, because the company thrives, they could do great. The company fails, they're worth zero, and the 10 or 20 years worth of work that they put into it is gone. So entrepreneurs will oftentimes exit because they just need to take money off the table. They might want to sell a portion of the business and then invest it in the S&P 500, or just, if another crash happens and the company just goes down, then they'll be killing themselves for the fact that they didn't take some money off the table prior to it. So taking money off the table is another priority for an entrepreneur in terms of exiting a business. And the third, and I unfortunately do see this quite often, is just mental exhaustion. Just mental and physical exhaustion of, I've been doing this for 5 years, I've been doing this for 10 years, I just can't do this anymore. It's tough. It's hard to be an entrepreneur. And some people are made for it and some people aren't. But even people that are made for it, to be able to have that type of intensity, and entrepreneurship is great because it's so intense and you're creating your destiny and you're creating your future, but at the same time, it's intense. And every day is hardworking, and some people just can't handle it anymore. So 100 Flowers, when we acquired companies, those are the three primary reasons why those companies exited. Let's talk about Everyday Health. Everyday Health. So Everyday Health, between $200 and $250 million in sales, all in a 10-year time period of going from zero to $200, $250 million in sales. The company actually filed an S1, which is what one needs to file to go public. Hired a number of bankers. This is all public information. Hired a number of bankers to help in the process of getting the financials in order, finding suitors. After going through that whole process, they spent a year going through the process, and they pulled the entire thing back. Millions of dollars spent, but they decided that it wasn't the right timing for them to go public because the size of the company, frankly, wasn't big enough. To be a publicly traded media company, there's no right number. I mean, the street, frankly, is public, and it does $50 or $60 million. It shouldn't necessarily be public, but to be a public traded media company, you need to be in the $200, $300 million type revenue business, or else there's just frankly too much risk. 2-3 years later, they then refiled an S1, and the company proceeded with going public. And they went public at about $14. The stock today is at about $10, roughly a year and a half after going public. I thought it'd be interesting to just talk about some of the differences in having been an employee when the company was private than when the company was public. Because, make no mistake about it, being public heavily influences the executive decisions, the board decisions of a company. So I'll talk about 3 or 4 different areas. So historically, without going into Everyday Health specifically, historically and typically, when you're public, you're focused on the quarter, and you have to hit that number. You have to hit that quarterly number. You have to beat that quarterly number. When you have to hit a quarterly number and quarterly number and quarterly number, the ability to significantly invest dollars in the business, in the P&L, that's going to take profit down, that's going to lower your EPS, is a hell of a lot more difficult. And this is obvious, but when you're living it, it's unbelievable. than when you're a private company. And you don't necessarily have to hit the street expectations for a number, which means that at the end of every quarter, it's going to be, how am I making sure to grab every single dollar that we can within this quarter? It's making sure that any investments that one's going to make is going to have a shorter time frame in terms of payback. Many companies make the mistake by going public too quickly because it doesn't allow them to invest appropriately in the business's growth. I see it, you see it all the time. And kind of that's one big difference. The second is there's just a lot of administrative costs of being a public company. With Sarbanes-Oxley, with financial disclosures that are required, with the need for an investor relations person on staff, with the need for higher levels of accounting that are required, whether from a big accounting firm, that actually has a $1 million, $2 million like cost attached with the amount of legal fees that one needs to pay, whether to file, which is a one-time thing, which is not a big deal, but the ongoing legal costs of continuing to be a public company, disclosures that are required, there's true administrative costs that actually take down profit and true transaction costs of being a public company. And we definitely felt it because we saw it. Next is, because short-term orientation is so important, and because it's very difficult to invest in one's P&L, meaning spending dollars, operating expenses, the growth avenue tends to shift quite dramatically from internal investment to M&A, to acquiring companies. And you'll see many, many public companies, frankly, one of the reasons why they become public in the first place is because they get access to more cash when they're public. And that cash is an avenue for M&A. And then when you spend $20 million on M&A, you're acquiring a whole bunch of revenue and a whole bunch of profit that then makes it easier for you to demonstrate growth in the short term, for you to hit your quarterly numbers. There are public companies out there that frankly make it a habit 2-3 times a year before each quarter, they're doing some acquisition, and then when they disclose their numbers, they sometimes do not disclose what the numbers were pre and post, and they disclose the total numbers. They say, oh, look at how much I grew. We just grew 15%. Yeah, but you acquired a company that was growing at 20%. You actually lost 5%, but no one knows that. Instead, when the analyst calls happen, they'll say, it was a meaningful percentage of our growth, but was it over 100% of your growth? They don't say that. So definitely much more M&A after being a public company. And the last is actually things much higher level of stress. Employee, when you have a box score every single day, which is your strike price, which is your company's stock price, and you know what your strike price was because you came in, you had options, and you're underwater, and you came in, it's worth $12. You worked really, really hard to get there. Well, when you're in the earlier stages of the company, it's motivating to have these options because you don't know what they're worth, right? And sometimes the human psyche is more motivated by not having information because it could be worth $100 if it's at $12. You don't know what it's worth. But once you actually know what it's worth, that motivation actually tends to decline. And it's actually harder to motivate employees after going public, certainly when the stock is below what one's options are. But even if it's above, you have knowledge, and knowledge means you don't have the ability to dream quite as much. And that dream is a great source of employee motivation. Seeking Alpha, great company, as I mentioned. You don't want to be acquired when your growth rate is so high that you could demonstrate much higher levels of revenue. But at the same time, you also don't want to wait until you're more flattening out and that your revenue might be higher, but your growth rate is lower. All in, it's actually much better to sell when you're in a high, steep growth rate than when you necessarily have a high degree of revenue. Because it's about the dream. It's about what the business can become. When you have high growth rate, even off of a lower revenue base, when you take that over 5-10 years, wow, look at what it turns into. When you have high revenue with a low growth rate, there's no dream. It's not that exciting. What can that company be? So companies that know they're in a path towards not being acquired need to make sure that they sell at a time of very fast revenue growth rate because that's where the multiples are going to be highest. For Investopedia, it's a totally different story in that Investopedia is owned by IAC. They mentioned we own a 30, 40, 50 different amazing brands. IAC has brought 8 companies in its history public. Expedia, TripAdvisor, they all used to be home shopping. They used to be part of IAC, and then IAC essentially spins them off and they become public companies. IAC's done that actually 7 times. The 8th time that it's about to do that is another month or 2. They just announced there's going to be an IPO, as you may have read, about Match, Tinder, OkCupid, the dating sites. And all those will be having an IPO. And so a path. So hopefully that's helpful in just talking about kind of a very wide variety of different experiences from both sides of the table.
So when you're an undergrad and you were trying to figure out what you wanted to do,
Yeah.
We're in college and we all take this risk as entrepreneur students.
Sure.
Everybody's focused on accounting, finance, getting that, Big Four, Goldman Sachs, and it's risky to deviate off that path. And what, I'm sure that was flowing through your mind when you were deciding to kind of veer off, and what ultimately made you decide to take a more entrepreneurial, holistic approach rather than just a micro-focused approach?
Awesome question. Okay, so the starting off with real experience in finance and accounting and those types of classes, I can't underemphasize how important those classes actually are, because they give you the foundation to be able to be more successful entrepreneurs or whatever you're going to ultimately do. They really are foundationally important. For me personally, it was having lots of lunches and meetings with people who had taken as a career a full finance path and staying in Goldman Sachs, and becoming a partner in a consulting firm. Lifestyle was really important to me. Not traveling too much. I got married at 24, and I had a kid at 26. Like, I have a 14-year-old now, which is kind of crazy, because I feel like I'm still 14. But not traveling too much was really, really important to me, and frankly, not working the 18-hour days that one worked for a sustained period of time was very important to me. Working 10, 12, 15-hour days, whatever it is, for a year or 2 was absolutely acceptable to me. Working for those type of hours for 7 to 10 years was not. So for me, it was a very easy decision, but ultimately the best thing that I did was asked as many people who are in their 30s and 40s and 50s just to go to lunch with me. And the receptivity to just going to a lunch and people wanting to help people and mentor people was so high. People would say to me, I don't know why more students don't ask this. Or not forget students, why more first or second year associates don't ask that. And this genuinely just earnestly asking for advice. And you'll find the right path for you once you start asking those type of questions and get that exposure. Yeah.
I mean, obviously, to grow your business, you have multiple facets, outlets that you need to optimize.
Yes.
And you only have a certain budget to allocate. You're obviously pivoting constantly. How do you know when to pivot, what to test, how much to put in?
Such a great question. Okay, so we have all these different avenues. So let me just list out the avenues, right? So we could grow traffic through email. We could grow traffic through, our content could be used in email. Content can be used in social. We have 400,000 Facebook followers. Content could be used on our site. Content can be used, we're in business development deals where we put our content on Yahoo Finance or on Bloomberg that then gets traffic back to our site. So we literally create, so now to answer your question, we literally create a matrix of all the different ways in which we could use content. And the key is having multiple purposes for everything that we create. So one piece of content, I'll give you an example, like something that did really well on Facebook was top 10 finest movies. Okay, we had like tens of thousands of people that liked it and commented on it. Top 10 finest movies ever made. That's something that did great, but it's very great. It's great for social, but you're not going to end up creating like all these newsletters around that type of content. Conversely, analysis of an individual stock, like we think that Yahoo is a great buy because of Alibaba, transition, etc. That could be really interesting in a newsletter about like a stock recommendation, but that's not like socially interesting. Like no one on social is going to be like, wow, I gotta pass this one on to this is I'm going to like this thing and put it on my feed. Like, that's not going to happen. So the bottom line is, you look at all the different avenues, and we try to create content that has multiple purposes,
Right.
and we always reuse one piece of content in multiple avenues to do it cost effectively as
You do the
possible.
test matrix.
Yeah, so we
The
do.
variables, right? Because it's a threshold. There's like all the content is proprietary. You need good content for long-term growth. But you
Yes.
also need content to spike it up
Yes.
constantly in the real time, and it's also traced back to your SEO.
Ooh,
keywords,
you know
things
your
like that.
stuff.
Sort of.
No, but
But where's it? I mean, are you constantly testing small avenues to optimize that? Just
Beyond.
perpetually.
We're creating 20,000 pieces. So we put content in 3 buckets. Okay, there's evergreen content that's timeless. Like, what's the difference between a 401k and an IRA? That will live forever. Social, no, but it will live forever. The evergreen will grow over time, right? Then we have semi-timely, something like, how does Costco make money? It's relevant for the next 3 or 6 or 9 months, but it may not be relevant if Costco changes its model.
Right.
And then we have timely content that's basically news. And it's like, Donald Trump was just on Saturday Night Live and he, sucked at it or whatever. We won't say that, but it'll be something like, the Greek crisis just happened. What does it mean for me in terms of my travel interest to Greece over the next year or so? That's totally timely. That doesn't have that much shelf life. And we'll look at actually the curve of, I'm going to use this thing. So you create a news piece. Here's what happens. Huge spike. No SEO value, doesn't give you any value for the future. You create an evergreen piece, does do nothing in the beginning, but then year 1, year 2, year 3, long value that happens over a period of time. Every piece of content that we create, we actually came up with something called DTE, which stands for days to even. We literally know exactly how long it takes to break even every single piece of content. So a news piece might take 1.5 days to break even on that piece. But this piece might take 3 years to break even on that piece. And every one of our editors has a spreadsheet that starts blinking blue whenever that content piece breaks even, because on an hourly basis that spreadsheet updates. And we'll know how much traffic we got to the piece, what the advertising revenue was for the piece. We know how much we spent and cost for the piece. We do the math, and kind of that's how we do it. So it's extremely
You
like
have ROIs for each.
every single piece of content, and for every category and for every subcategory. And we have a monthly content meeting where we sit and we look at all the data that we have, and we're like, whoa, we better heavy up on retirement content because it's killing it. Oh, this Forex content is doing terribly. Kill that. Oh my God, whenever we put the words best of 2016 in there, it does unbelievably well. Now, so my content analyst just told me today, he's like, so we created 400 pieces of content about best of 2016. I'm like, great. So it's really scientific. And again, science and data really wins.
So what does a startup to do?
So the number one is
Constant refinement.
yeah, it's just data. Like, invest in the infrastructure to capture all the data that you need to make smart decisions. If you're a startup, do not just go by your gut. Go by your gut in terms of directionally what you think makes sense. But you need the combination of art and science. It can't just be art, and it also can't, by the way, just be science. It needs to be the combination of the two. And you need to invest in the infrastructure for data. Okay, last one.
So a couple things for that, and good question. I have a comment and then a question. So for you, the idea of this course, a lot of it's built around this lean launch pad and ultralight startup, which is all about testing hypotheses, right? And
Awesome, great.
It has data, that's actually testing. So it's not about guesses. It's about kind of a scientific, evidence-based method.
Great.
So it's very interesting. That's the comment. The question is, where does the content come from? So you probably have some people in-house that you pay. Maybe you pay journalists so much a word. I've also noticed on Harrow, help the reporter out, more and more queries for Investopedia.
Yeah, because we're growing so much. Okay, so first I will tell you there's a great technology out there for testing on the web, and it's called Optimizely. And what it allows you to do is optimize different iterations on your site, and you could just throw 10 different things, 10 take 2% of your traffic and put it to this, 20% of your traffic, put it on that, 5% of your traffic on that, and optimize this would be red, this would be green, this would be blue, and you'll get the exact data around all this information. It's a phenomenal. The reason why it's so great is because it does not involve any tech and development work to actually implement it. It's just so that's huge because tech costs are so high. So definitely recommend that for startups. The second answer to your question is the way we're structured is we have a head of editorial. We have 8 editors, like a video editor, a personal finance editor, a retirement editor. We don't have a single writer on our staff.
So where does the content come from?
We have 300 to 500 experts. So we have an expert in Bitcoin. We have 3 experts in Bitcoin. And every time we come up with an article, we will send it, we will know who the expert is, and we will get a higher quality of content by giving it to an expert in Bitcoin than by giving it to one of our writers. If we have 5 writers, we couldn't have 500 experts. We would have people who might be an inch deep and a mile wide. So our model is, let's get the experts that know their stuff, and we pay them between $100 to $300, depending on the length of the article. And then if someone's really good, we'll say, okay, we're going to give you a batch of 30 articles. Here's a batch of 20 articles. And that's the way we do it. So it's all through kind of freelance writers.
Those experts are freelance per piece.
Yep. But we have their bios on our site, and they get their name on it as well. So, it's not like it's just Investopedia.
And is there a range for what you pay them?
Between 100 and 300.
Per article?
Per article, depending on the length of an article.
Okay.
Longer articles tend to be more sophisticated because they can go into more depth on something. Short articles are going to be more superficial, so we'll pay less for a short article. We also use a third party called Crowdsourced, which has a network of hundreds of writers that is also a cost-effective way of producing quality content.